There is a silent operating system running in the background of your life, a financial code that the wealthy understand intimately and use every single day, and it allows them to generate perpetual tax-free wealth while you remain stuck on the taxable treadmill. It's a tale of two playbooks. In one corner, you have the worker's playbook. You earn an income, the government takes its cut first, and you live off the rest. It's a linear game of trading time for money, and taxes are your constant, unavoidable partner. In the other corner, there's the owner's playbook. Here, assets grow, wealth compounds, and taxes are optional, an afterthought. The core premise of our entire financial system is this: the tax code is not designed to be fair. It is designed to reward owners. And today, we're pulling back the curtain on the single most powerful strategy in the owner's playbook. It's called borrow until you die, and it is the engine that creates what I call the zero-tax snowball, a force that lets your wealth compound so fast, the IRS can't even get its boots on. Let's make this real. Imagine you follow the worker's playbook. You save diligently and buy an investment property for $400,000. A few years pass, the market does well, and your property is now worth $500,000. You've made $100,000 in equity. The worker's instinct, the one we are all taught, is to cash in. Sell the property, realize that profit, and put that $100,000 in the bank. But the moment you sell, a transaction is recorded. The IRS gets a notification, and a hand reaches out for its share. This is called a capital gains tax. Depending on your income, that's a 15 to 20% tax on your profit. So, your $100,000 gain instantly becomes $80,000. You've just paid $20,000 for the privilege of accessing your own profit. Selling is a taxable event. It resets your journey and shrinks the very capital you need to take the next step. It's a trap. Now, let's switch to the owner's playbook. Same exact situation, a property bought for $400,000, now worth $500,000. The owner sees that $100,000 of appreciation not as a profit to be taken, but as fuel to be used. The owner lives by one simple rule: never, ever sell an appreciating asset. Why? Because selling is a taxable event. But borrowing is a non-taxable event. This is the foundational secret. When you go to a bank and take out a loan, that money is not income. It's debt. The IRS cannot tax you on money you've borrowed. This simple truth is the mechanism that unlocks the entire strategy. It allows you to access the value locked inside your asset, your equity, without ever sending a notification to the taxman. You get the cash without the consequence. So how does this work mechanically? The owner of that $500,000 property walks into a bank and asks for a cash-out refinance. They have an asset worth $500,000. The bank will typically lend up to 75 or 80% of that value. Let's use 75%. That's $375,000. Let's say the owner still has $280,000 left on their original mortgage. The new loan pays off that $280,000 balance completely. And the difference? That $95,000, $375,000 minus $280,000 is deposited directly into the owner's bank account as a wire transfer. Tax-free. Cash. It's like walking up to your house, inserting a debit card, and pulling out 95 grand from an ATM. It's your equity, liquefied, with a $0 tax bill. At this point, the worker's conditioning kicks in, but you just took on more debt. Your mortgage is bigger. This is the fear that keeps people trapped. Owners, however, have a different fear. They don't fear debt. They fear taxable events. Debt is not a threat. It's a tool. It's a lever to amplify wealth. The only rule is that the asset itself, the property, must generate enough cash flow from rent to service the new, higher mortgage payment. As long as the asset pays for its own debt, the debt is irrelevant to your personal finances. And what does the owner do with that $95,000 of tax-free cash? They don't buy a boat. They immediately use it as the down payment on their second asset, asset number 2. And this is where the perpetual cycle ignites. This is the borrow until you die loop in its full glory. You buy asset 1. It grows in value. You pull out tax-free equity by borrowing against it. You use that cash to buy asset 2. A few years later, asset 1 and asset 2 have both grown in value. Now you can borrow against both of them to pull out an even larger chunk of tax-free cash. You use that to buy asset 3 and asset 4. It is a continuous compounding loop of buy, let it grow, borrow tax-free, and buy again. This is how real estate moguls build massive portfolios, going from one single-family home to 100 units. often without ever paying a single dollar in capital gains tax along the way. Their wealth is constantly working and compounding, completely shielded from taxation. And this isn't just for real estate. This is the exact principle billionaires use. When you hear that someone like Elon Musk takes a tiny $1 salary, this is why. He doesn't need income. His wealth is his stock. He simply borrows against his billions in stock to fund his lifestyle tax-free. But here's the final, incredible piece of the puzzle, the die part of the strategy. It's a provision in the tax code called the step-up in basis. When the owner who has spent a lifetime acquiring this massive portfolio of assets finally passes away, their heirs inherit everything. And the IRS code says that for the heirs, the cost basis of those assets steps up to whatever the fair market value is on the date of death. All of that built-up, untaxed capital gain from decades of appreciation is legally, permanently, and completely erased. It vanishes. The heirs can sell everything the next day and pay zero capital gains tax. It is the single greatest loophole for generational wealth transfer in the entire tax code. Now, I know what you're thinking. This all sounds great, but it feels exclusive. It feels reserved for people who already have that first $400,000 asset. The average W-2 worker, stuck in the relentless cycle of earn, get taxed, and spend, seems locked out of the owner's game. How do you get the seed capital to buy that first asset and kickstart the entire process? For a long time, this was a legitimate barrier. But a critical shift in the economy, combined with a powerful piece of the tax code, has blown the door wide open. The entry vehicle is real estate, but a very specific kind, short-term rentals or STRs. This is the twist that makes the entire strategy accessible to you. Here's how it works. When you own and operate a short-term rental, and you meet a standard called material participation, meaning you're actively involved in running it, the IRS allows you to treat it as an active business, not a passive investment. This is the key. This classification unlocks one of the most powerful tax deductions in existence, bonus depreciation. In simple terms, bonus depreciation lets you take a massive paper loss in the very first year you own the property. You can accelerate the depreciation of everything from the furniture and appliances to the carpeting, often totaling 20 to 25% of the property's purchase price. And here's the crucial link. Because your STR is an active business, you can take that enormous paper loss and use it to offset your active income, your W-2 income from your day job. Let's put it all together. This is the zero-tax snowball in action. You earn $100,000 a year at your job. After taxes, your bill is about $20,000. You're left with $80,000. But this year, you buy a $500,000 TR. Through a cost segregation study and bonus depreciation, you generate a paper loss of $125,000 in year one. That loss doesn't just wipe out any profit from the rental. It flows directly onto your personal tax return and completely wipes out your $100,000 taxable salary. Your tax bill goes from $20,000 to zero. That $20,000 you were going to send to the IRS is now sitting in your bank account. That is your seed capital. You just manufactured a down payment out of thin air by legally eliminating your tax bill. This is the money you use to fuel the perpetual borrow until you die cycle we just mapped out. Now that you have the playbook, the only thing stopping you from escaping the worker's trap and playing the owner's game is taking that crucial first step to acquire your own asset.